So this is our earnings call. We are Built Different Technologies. I'm Dean Kubosh.
I'm Melanie Carpenter.
I'm Tiffany Russell.
And I'm Michael Reed.
For strategy differentiation, our current strategy is to keep our PQ higher than our competitors. And in order to do this, we have heavily invested into research and development in the early years, allowing us to keep our prices competitive to the overall market. Our PQ rating for cameras is about 30% higher than the industry average. For drones, we are top 3 in our industry, about 20% higher than the industry average. For our warranty periods, our cameras are above average in all regions except for Europe and Africa. And for drones, we are currently above average in all regions. Next is Melanie.
Thank you, Dean. So taking a look at our performance versus investor expectation, we exceeded expectations set for the return on equity by over 20% in year 12. Our earnings per share exceeded as well by about 36 cents, and our stock price additionally exceeded by $6.61. We did fall short on our credit rating. We got an A- when the expectation was an A, and this was due to us repurchasing stock, and this led to a decrease in our financial performance. The image rating we have set at an expectation of 77, and we exceeded this with a score of an 89 in year 12. And this is due to our aggressive corporate responsibility initiatives that we have, donating 10% of our operating income to corporate responsibility initiatives. And we additionally earned the award in years 11 and 12 for our work. I'll pass this off to Tiffany now.
Thank you, Melanie. So for our performance evaluation, we focus mostly on our earning per share decreasing and our return on equity decreasing. So for our earnings per share, we did not repurchase as much stock as we have in previous years, which caused this to go down. However, we do have the lowest amount of stock outstanding in the industry, which is something that we want to point out and highlight. Looking back at this, we would have focused more on pursuing actions that raise our net income, such as adjusting the warranty periods for both the camera and drone, or changing our sales promotions and discounts and putting more of an emphasis on that. And we would have not relied on buying back stocks as much to increase this, since it doesn't really help us in the long run. And for our return on equity, we repurchased less stock, resulting in the return on equity to decrease from high levels. And we also put extra money into increasing the PQ rating of our camera and drone above the industry average. So looking back, we would have allocated more money into marketing efforts instead of our R&D expenses. And I'm going to pass this on to Michael.
Thanks, Tiffany. So for the next fiscal year, our strategy is sharply focused on reinforcing where we are in the market and our standing, and achieving our ambitious financial objectives, including an improvement to our earnings per share and other investor expectations to meet. As you can see, we do have a difference in what our year 13 performance target was for our stock price and what the investor expects in 13. And that's due to our over success with our stock price in year 12. We actually had a stock price around $254, which is what made the investors' expectations go up to about 300 there for year 13. So that's going to be the expectation that we're going to be following and trying to meet. As well, we have a very significant R&D expenditure that is central to our strategy, and we're going to aim to continue that high investment into the R&D. But our total R&D expenditure is actually higher than the rest of our competitors in the industry. And so even though we are going to continue our high R&D expenditures, that will be core to our strategy going forward still, we're going to reduce our relative spending on that. So it's going to be a reduction, which will let us increase spending elsewhere, but it'll still be high relative to the industry average. Concurrently with this plan, we're going to be taking some rigorous market analysis to ensure our pricing strategies are are reflecting the superior quality of our product. Along with that too is going to be our efforts into identifying and penetrating our existing markets and where we're operating, and trying to increase our market size there. So on those efforts, we're going to be investing into advertisements and making higher advertisements expenditures. That'll help our overall market share, our market share of each of those different areas that we can identify. That'll help improve our profitability in those regions, especially looking at the exchange rates, and taking into account any other fluctuations in demand, and trying to meet those demands in our operational capacity. On that, we're going to continue our operational efficiency, especially when it relates to manufacturing. This will help our overall approach as it keeps our costs low in that area. And so one of those investments that we make and are going to continue to make is going to be our investments into the best practices and productivity improvement training. Those will improve our efficiencies with the labor we do have, and making them more skilled and more qualified, giving us a better product, without having to invest too heavily into further manufacturing capabilities. Our confidence in this strategy going forward for next year is really related to our track record. We've had a continuous track record of being able to leverage our product and command a premium price for it, while historically having good growth and profitability as well. So by intertwining these elements and adjusting our R&D, we're looking to see a very successful next year. And onto that, we'll move into any questions.